Welcome, I'm Catherine Magaña here with Rachel Ivanovich, where we're here to provide you our Savvy series. And today we're going to discuss summer tax strategies for affluent women. And so as we are here, it's the middle of June pretty much, and half the year is over. And
kids are out for school.
I know, thinking vacations, graduations.
Traveling.
Yeah, mid-year. There's a lot going on right now, but it's a good time to kind of revisit. And so we're going to go over a couple items with you today. And I think the first step is kind of looking at, now that we're in the middle of the year, where are you at with your tax withholdings?
This is the prime time for tax planning, and tax strategies aren't optional; they're essential, especially for everybody. And so it's the time of year. On Monday is actually the second quarter estimated deadline, believe it or not, June 16th. So this is the time of year to pull your pay stub, look at how much withholding you've had so far this year. If you need to make estimated payments or quarterlies, a lot of people call them, and June 16th is the second deadline to do that. Basically, what you have to do if you have any investment income or if you're a small business owner or if you have any other income that doesn't have withholding, maybe you are already drawing Social Security, you're taking distributions off of IRAs or 401ks, it's time to really look at and reassess, have I paid in enough? How much is enough? There are rules that the IRS and the states have. They're called safe harbor rules. So you definitely want to make sure that you're looking at if you haven't filed your taxes for 2024 yet, you can still apply safe harbor estimates, but you kind of have to estimate even more than normal than if you had already finalized your taxes for the prior year.
So it's interesting. I had a call with a client yesterday, and this is the first year she's actually doing estimated taxes.
And it scares people.
Yes. And so I was like, she mentioned it. And I was like, oh, yeah, it's due, it's due
June 15th.
Yeah. And she's like, oh, it is? I said, yeah. I said, well, if you're doing estimates, this is the second estimate because there was one in April. And she's like, there was? I said, well, you may want to go talk with because she's not a tax client. So I was like, you may want to go talk to your tax advisor because she didn't realize, I think, that she needed to pay in
And people get nervous about that when that happens, but there's a way to make it up.
Okay.
So in case you didn't make your first quarter estimate and maybe you don't have enough cash sitting in reserve to pay your second quarter estimate, you can do it through withholding. So if you pay in your annual tax liability through withholding, be it your paycheck or IRA or 401k distributions or even Social Security, it's treated as if it's paid in ratably throughout the year. So therefore, you don't get penalized.
Interesting.
So there are different ways to make it up. We have some self-employed individuals where they pay themselves at the very end of the year and then they have all of it withheld and to go towards taxes because maybe they haven't paid anything in yet. So just make sure you're working with your tax advisor. Call us. We'll be happy to go over whatever your year-to-date income is and make sure that you're hitting those safe harbor estimates so that you don't pay any penalties.
Okay, so another thing to consider is maximizing your retirement contributions. So I know we've talked about this in the past, but I think this is a good time. We're in the middle of the year. Look at your 401k or
statements, yes,
and see where am I at? Am I on track?
Mine just came in the mail yesterday.
Did it? Nice. Like how much did I put in?
I know.
And if there's ways, do you want to maximize your contribution because the contributions limit change every year, or if you're over 50, there are some catch-up contributions that you can do in your 401k, or even if you have a simple or some other type of retirement
And employers match, so make sure you're taking advantage of that as well.
If your employer matches, so yes, absolutely. And then we've mentioned this in the past, but just to reiterate, the Secure Act of 2.0 that came out does allow for a super catch-up. So for those that are between age 60 and 63, that the super catch-up for 2025 is $11,250 if you're putting money in a 401k plan. So that's something to consider.
And if your employer doesn't have a 401k or a 403b or some sort of 457 plan, you also can contribute to a traditional or Roth IRA.
Right.
And it's not too late to start to do that. With the traditional IRA, you get the tax break when you file your taxes. So make sure you're telling your tax advisor that you made a contribution to a traditional IRA. With a Roth IRA, it's not as important to tell your tax person, but we do like to know that you've made that contribution because we like to track how much you've put in. We call it basis to make sure that later, if there's complicated rules around them, but we definitely want to know if you're making those contributions to a Roth or a traditional.
And then going back to the catch-up, if you're age 50 or more, then you can do the catch-up, and you don't have to wait till you're 50.
Extra $1,000 a year for
the
for
IRA
Roth.
and Roth. Yeah, so you don't have to wait until you turn 50. You can do it in the year that you turn 50.
That's true. That is true.
Okay, so another thing to consider is, mid-year, is there potential Roth conversion? I know this is something we look at a lot of times towards the end of the year, but obviously starting those conversations or start thinking about,
I think it's a really good thing to think about during the middle of the year, especially if you're having a year where your income maybe is not as high, or maybe you've switched and you're in between jobs. That might be a good year for you to consider. And definitely, you want to be looking at Roth conversions, I think in your 50s and 60s maybe, because once you start, planning for retirement, you need to watch that. Your Medicare premiums could go up if you do the conversion within 2 years before you start taking Medicare, because the IRMA, and that stands for, let's see here, income-related monthly adjustment amount or something like that. So basically, your Medicare premiums will be higher, but there is a 2-year look-back period. So for 2025, they're looking at your 2023 income.
Yeah. So once again, maybe looking at a partial Roth conversion, and what that means is you're moving part of your IRA money to a Roth conversion, and in that year that you do that, it's a taxable.
You have to pay the tax.
Yes. And then paying the tax could be either you pay it when you do the conversion, or if you have outside savings that you can apply for the taxes.
Yeah, I think that looking at your tax brackets and seeing where the next bracket starts is a really good place to begin, because a lot of people think, I have to convert all of it. I'm never going to have enough money to do it. But if you actually look at, okay, well, maybe I'm in the 12% bracket, or maybe I'm in the 22% bracket, and then where's the top of that 22% bracket before you jump to the 24?
So kind of looking at it is each person kind of case by case.
Exactly. You have to look case by case. It's not a blanket.
Yeah. Although I think based on all the articles we read, everyone it's always like, hey, just go do this.
Just go do it. Exactly.
Okay. The next one is planning charitable giving strategies. So obviously, if you are taking required minimum distributions, that's an opportunity for you to do the qualified charitable distributions. Or if you're over the age 70 and a half and you don't have to take required minimum distributions yet, the age for that is now 73. You can still do the charitable distributions at age 70 and a half. So if that's something from kind of a tax perspective, I think
that's a great idea. And so as you were saying, when you're 73, I guess you have to start taking your required minimums out of the IRAs. But in order to reduce your overall income, and one of the reasons that I think this is a great strategy is because the standard deduction is really high. And that could change at the end of this year. But right now, a lot of people are not itemizing. A lot of people are taking standard deduction. And so if you are charitable minded and you want to make sure that you also are saving on your taxes, instead of sending money or writing checks directly to the charity, you just take the money out of your IRA and send that and have your custodian or send it to the charity directly. Yeah. So that therefore reduces your overall taxable income.
And I think we recently found out that now, not all, but some custodians are now going to report the charitable distributions
on the 1099s.
Because in the past, you get a 1099-R and it shows a distribution, but then you have to make
amend tax returns because of that.
They didn't tell you that they did the charitable distribution. And so now going forward, supposedly there's going to be a code.
That would be nice.
Yes, but you still need to verify. I think it's, I'd still double,
Make sure you're telling your tax advisor that you did a qualified charitable distribution, because otherwise it's in the past we haven't had any way to know.
Yeah, and that's it's a huge tax savings if you don't have to pay taxes on that portion. So that's
and then another, if you are considering donating to charities. Gifting appreciated stock is another great way to reduce your overall tax burden. If you were going to be giving money to a charity anyway, let's just say that you bought stock for $100 a share and now it's worth $1,000 a share. If you turned around and sold it, you would realize a pretty large gain. But if you took that and gave it to the charity, they don't have to pay tax on it, and they also get the benefit of all that appreciation.
Nice.
So I think it's a great method to benefit charities.
Yes. Okay, so another item is mid-year portfolio reviews and tax harvesting. So basically, it's a time to kind of look at your allocation. I know we talked in the past, the markets have been a little volatile.
Little.
And now it's kind of, it's up for the year. We're a little stable from where we were a few months ago. But making sure, are there any kind of risk changes? Has any of your cash needs changed?
Your goals changed.
Yeah, and so this would be a good time to look at your allocation and make sure it's in line with what your goals are.
A lot of people like to wait until November and December to do tax loss harvesting, and I think it is a good time of year to review your portfolio and your tax strategy.
And so basically when you do have gains, and we actually had a conversation with a client this week, they have some individual, in their taxable accounts, they have some individual positions. And we were going over, they had some short-term and long-term gains. Do you want to go over how that works?
So the taxation on capital gains, there are 3 different brackets. There's a 0 bracket, which people forget about, and is actually very powerful with tax planning. But then most people fall into the 15% bracket.
Yeah, pretty standard, yeah.
And then the next one is the 20% bracket. And these are, of course, federal capital gains rules because most states, California doesn't have a preferential. So if you have assets and you hold them for more than a year and a day, then you qualify for the lower tax rates. And so you definitely want to be planning and proactively with your advisors so that you're not selling things before you can actually pay less tax. Come on, everybody wants to pay less tax.
Exactly. And then there's also, so that's the long and short-term gains, but then also there could be the state tax or some other taxes you have to consider.
There's also the net investment income tax.
I think it's overlooked a lot. We're like, I don't remember. I know. I need to pay that.
It's the surprise tax. They're like, what's that over there?
I know. Yeah. So that's something that has to be considered and factored in as well. But you're right. I mean, this is a good time. Let's revisit. And then obviously we have between now and the end of the year, too, to review
people, honestly, I see, this is one of the biggest mistakes that I see that clients make is just ignoring that tax planning until the end of the year. Because then you're rushing to put things in place, whereas right now it's a really great time where you can really think it through and be intentional with your tax planning and your finances.
Okay, so another item is family wealth and gifting strategies. So the gifting limit for 2025 is
$19,000.
Wow, okay,
$19,000.
And then, but then if you do more than the $19,000, you can still gift more. You just have to.
You have to file a gift tax return. But what you need to keep in mind is if you're married, you actually can give 38 because each spouse. And if let's say you're gifting to your children, your adult children, then you can double that again. So you really actually can gift way more than the $19,000 that they talk about, and that's really just what you can gift without having to file any paperwork. If you gift more than that, let's say you want to help your children, your adult children or grandchildren buy a house, help them with a down payment, then you just file a gift tax return, and there's no tax due at that time. It just reduces your overall. You just need to look at estate planning at that point, which right now, well.
That's questionable because
that's questionable too. I know that's going to change maybe at the end of the year if they ever can pass this new tax bill.
And then another funding source we see sometimes is parents or grandparents are funding the 529 or education plan accounts,
which I believe are governed by gift tax rules as well.
Yeah.
So those are definitely talk to your tax advisor. Or call us.
There you go.
We're happy to go over this with you.
And you can reach us at 760-692-5700. Okay, so just kind of recapping some mistakes that affluent women make and how to avoid them. A mistake is ignoring tax planning until November or December. So kind of what we talked about is let's just not wait.
Let's not wait.
No, and I think
let's get on it in June and July.
And I think what we find though sometimes is if they haven't done their taxes yet, they're probably still in that mindset of
Well, it's really interesting because everybody is, gung-ho in January through, April, and then people check out in June, July, and August. And then Labor Day rolls around and everybody's like, okay, it's time to look at taxes again.
You should be looking at it all the time.
You should be thinking about at least your tax and your financial strategy year-round. I mean, we've got the 4 pillars that we talk about, and let's look at one area of your financial planning each quarter.
There's so much and everything changes.
There's so much,
and there's a lot to cover. Okay, so another mistake is failing to coordinate with both tax and financial advisors. So here we are with Rachel. She has a tax planning background, so we're happy that you're part of our team. But for those of you that don't have that, obviously it's important that the tax advisor and the financial advisor are coordinating, because there's a lot of things that come up with, like we talked about, if you're going to sell positions or their gains. Or,
You know how many times a tax client has come to me and said, I did this with my financial advisor. I'm like, oh dear, why did you not call me?
Yes. So, and then the vice versa, like you want to make sure we're
Yeah.
in communication. So, and then basically a mistake is not making adjustments to your strategy or your plan when there's a change in your life. So occasionally
So
there
true.
could be a divorce, there could be a new marriage, there could be an inheritance, something that triggers your life that gives you a chance to revisit not only your financial
Retirement,
plan, but
or
also,
if you sell assets.
Yeah.
Those are really good times to talk to your tax and financial advisor. We want to know.
Yes, and not after the fact. We want to know
Beforehand.
Because it's always, can you fix this?
my
Or what can I
gosh.
do? Or like,
Not much now.
So that's why it's important that we're communicating.
Yeah.
Okay, so kind of a couple final thoughts are, we do recommend a kind of a mid-year tax review as well as kind of a mid-year financial checkup. So this is a good time just to kind of check in and
Before you leave for your summer vacation.
there you go. Yes. And then obviously this is something that's proactive and it's ongoing, and obviously a lot of things happen in life, and we're here along the way to be there with you side by side. So I know we covered a lot today. If you are interested in a complimentary strategy session, you can reach us at 760-692-5700. And we want to thank you for getting savvy with us today about your finances. And remember to savvy up. Please stay tuned for important disclosures. The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or any specific security. It is only intended to provide education about the financial industry. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. Any past performance discussed during this program is no guarantee of future results, and the indices referenced for comparison are unmanaged and cannot be invested into directly. As always, please remember investing involves risk and possible loss of principal capital. Please seek advice from a licensed professional. Savvy Woman Wealth Management is a registered investment advisor with the SEC.